Hi, everyone. I'm Gary Brode from Deep Knowledge Investing. We work with hedge funds, family offices, registered investment advisors, and individuals like you to help you get better returns in the stock market. I'm here with our host, Robb Fahrion. He's the CEO and founder of Flying V, our digital marketing partner. Rob, how you doing? How was your week?
Gary, week was great. Excited for a new one. Hopefully people can, what'd you say? People don't tune in for the audio visual quality. Got some issues going on with my background or something. I don't know. You said I look like a hologram.
I'm waiting for you to say, help me, Obi-Wan. You're my only hope.
Normally people would say just hopefully no one notices, but here at DKI,
Yeah.
transparency is king, right? So we make sure we address all the issues just absolutely head on.
Noted. I've had a number of people on Twitter, or X now. Um, they never criticize the work on here. They don't criticize
Yeah.
the analysis. They criticize my appearance. Like they think I'm not attractive enough. I'm like, Okay, but if you're tuning in because you think I'm pretty, like you got
Yeah,
the wrong channel."
that's a you issue, I
Right?
think.
Yeah, exactly. Like, is it just me, or is it weird for men on X to complain that I'm not attractive enough for their feed? That's just
I don't know. Put nothing past the audience on X, but hey, we're glad you're here. We're glad you may be listening to us wherever you're coming from. You've got a great issue this week. We're calling it the We Pivoted Bigly issue, which is great. We know we had the Fed funds rate last week was cut 50 basis points. We'll be talking about that. We're also talking about inflation again. Bitcoin obviously makes an appearance in that conversation. We've got Intel. Spoke about Intel, I think it was about a month and a half ago, circling back on that company, FedEx. And then finally, we'll get into some of our investor education topics that we've been added into the mix for this week's Five Things and ongoing Five Things. Gary, are you ready to rock and roll?
I am. Just one key thing, Rob, because we did call this the Bigley issue, and that's obviously a laugh related to President Trump. I've been informed by my political advisors we need to include the phrase "unburdened by what has been," so that we are politically neutral. Now that we've got that out of the way, let's go.
Here we go. Gary, as we mentioned, Fed funds rate last week was finally the big pivot everybody was waiting for. The rate was cut by 50 basis points. More cuts on the way, you're saying as well. Thing number one, Gary, the Fed pivot is here.
Yeah, so the Fed pivot is here. This is the moment that people have been waiting for almost 3 years. But last week, the Federal Reserve completed their September meeting. And prior to the meeting, everybody knew the Fed was going to cut rates. They started hiking in January of 2022. And the thing that I think is really interesting about this is Chairman Powell, over the last 2.5 years, has been very clear saying we are going to get inflation down to that 2% target, which, as I've said many times, is 2% too high. But, whatever. Powell and I disagree, and that's just the nature of the world. Um, but it did look for a long time like he was going to hold the line on that 2%. Instead, uh, you know, I think the Federal Reserve has realized the thing that Rob, you and I have been talking about for more than a year at this point, which is they're seeing a bifurcated economy. I think they're starting to understand that the employment numbers are fake, that the aggregate economic numbers look good, but it's supported by huge amounts of spending out of the government, and that most people, most Americans, are not doing so great right now. Inflation is understated, and um, it's running well ahead of people's wage gains. And so while the employment market isn't awful, the inflation market is awful. And so for that reason, I think that's the reason they pivoted and cut, in my opinion, early. Um, I would have liked to have seen them wait longer, but I get the logic here. The thing that was a surprise to me was they went with the larger 50 basis point cut. That's 0.5% instead of, some of us, including me, expected a 25 basis point cut, a quarter of a point. 1 basis point is 1/100th of a percent. And, I think the reason for that is they're seeing the same things we are, which is most Americans are not doing so great at the moment.
Gary, you mentioned, you thought 25 basis points. Now it's 50. You still maintain that you think the cut is unwise. Obviously, you talked about the 2% inflation target, 8 million jobs available. But then also, most importantly, Congress just does not seem to get it, right? And in terms of this being a bipartisan problem, whether red or blue, the amount of spending that is going on at Congress is going to continue to have this be a topic of the 5 things for probably a while to come.
Yeah, and I think that's the key point here, Rob. What is causing our inflation right now is not the current policy out of the Federal Reserve. It is overspending from Congress. Historically, the Democrats had been the party of big spending and, big government programs, and Republicans had been the party of fiscal conservatism. That is no longer the case. Both parties now are in favor of insane spending levels, and nobody has on either side, on either Team Red or Team Blue, has any plans to cut spending. They're not even talking about it. So it is a bipartisan problem. We're not taking sides at DKI. We talk about policy, but not politics. But this is one of those situations where I disagree with both parties. So, if you have a problem with that, put it in the comments and, we'll read it. But that's where we are. More importantly than all of this, I just want to make 2 key points. One is, as we're talking about this, Andrew's going to put up the chart of our inflation from the 60s and 70s and compare it to what we've had in the US over the last 11 years. And those charts overlap. And you can see where then Chairman Arthur Burns cut rates too soon, and we just got this huge spike up in inflation. And that's exactly where we are in this part of that. Now, that's why I'm saying I think Powell cut too early. I think that cut, that 50 basis point cut and the Fed, they're going to cut another 50 basis points between now and the end of the year. They've made that clear. But that cutting into massive amounts of congressional overspending, again, both parties, is what is going to keep this inflation problem going. And, this is not going to be a 3-year problem. This is going to be a problem for a lot longer than that. But, the key point is it's easy to get upset about all this. And the message that I have for everybody is we get the market we get the conditions we get, not the ones we want. And if your reaction to that is to be unhappy, then I'm sorry, but there are better options. As usual, at DKI, we're going to invest based on the market that we have. Our portfolio is well prepared for higher inflation over the next few years. We're very heavily hedged. We own things like uranium, oil, energy, gold, Bitcoin, silver, things that will do well in an inflationary environment. And, the other thing I would add is our last our last 3 individual stock picks, not commodities, not Bitcoin, not gold. Our last 3 stock picks have been very high revenue growth, high potential return companies that I think are not economically sensitive and will continue to grow revenue at a high level, regardless of future Fed actions. So the point of all this is, you may not like what's happening. I don't like what's happening. But when it comes to investing, there's always something that you can do. There's always a way to position yourself to make money from policy that you disagree with. And so the key thing isn't whether I agree or disagree with the Fed, whether I agree or disagree with Powell. The key thing is that we're positioning our portfolio to take advantage of this and make money in, if the environment isn't the one we want, it doesn't matter. It's still our job to make money. And that's what we're focused on.
With the lower rates, Gary, transitioning to thing number 2, obviously we're talking about more inflation, reduced purchasing power for the dollar. We've seen Bitcoin rise over the last week or so with the expectations of that weaker dollar. So thing number 2, Gary, we're basically just getting a Bitcoin update, thing number 2.
Yeah, so MicroStrategy has continued to buy. I think recently they raised $750 million through a convertible debt offering and purchased $1.1 billion of Bitcoin. I think more than 18,000 Bitcoin. Michael Saylor has been, he was early and right and very clever in the way he structured all of that. The key thing here is that when the Federal Reserve cuts interest rates, you end up with 2 effects. One is the advantage of holding securities or dollars, which have a current yield, meaning you get interest on it. Well, the amount of interest you get holding dollars just went down. And obviously it depends, right? The long end of the curve, actually the yield went up on that. So the long bond went down, short bonds went up with a lower yield. But anytime you cut the amount of interest that you're getting on dollars, it makes non-yield instruments like gold or Bitcoin relatively more attractive. And so that's what you saw. The other thing is the Fed cutting rates too early, again, means we're going to have more inflation. And if that's the case, right, think about inflation as a reduction in the purchasing power of your dollar. Well, that doesn't affect Bitcoin. It doesn't affect gold. And so, if the dollar loses purchasing power, but these harder other assets, again, like Bitcoin, don't lose purchasing power, then the dollar price of Bitcoin goes up. And that's what we've seen recently.
Gary, are you seeing with everything that's happening, and it seems like with chatter in the market, that Bitcoin is just becoming a critical asset really in any diversified portfolio?
It's a great question. And, BlackRock just came out with a white paper on it, which I think is kind of funny because, they were very anti-Bitcoin until they realized that they could start their own ETF and make money from it. I don't know that anything is crucial, but I think it's wise. And, my largest position in my portfolio right now is Bitcoin, partly because I bought a large position and partly because we were buying it, at about a fifth of the current price, a quarter of the current price, a fifth of the current price. So, it's that position that I bought has quadrupled, quintupled, something like that. So for me, it is a gigantic position. Um, and so, I don't know that anything's a critical asset, but it's certainly something that I would recommend holding. If you feel like I missed it, it's too late. You didn't miss it. It's not too late. The purchasing power of the dollar is going to continue declining. The one thing that I would convey to people is understand the difference between the short term and the long term on this. So a lot of people have looked at Bitcoin's performance over the last few years as we've had a lot of inflation. And there were times when we had a lot of inflation and Bitcoin was going down. And I said, hey, it's not a hedge for inflation. Well, short term, Bitcoin behaves as a high beta proxy for tech stocks, which basically is just a fancy way of saying whatever the market is doing, Bitcoin does that in greater size, right? If the market is up 1%, Bitcoin will often be up 2, 3, 4%. If the market is down 1%, Bitcoin will often be down 2, 3, 4%. So that's all that means. So in the short term, it's a proxy for high volatility tech stocks, like the NASDAQ's QQQ. In the long term, it's absolutely an inflation hedge. And if you're going to get future inflation, and I believe we will, then you want to own things that will hold their value, meaning you will get more dollars for that. Again, Bitcoin and gold are great options for that, as well as energy, which we've owned for years.
Gary, moving to thing number 3, we're going to jump back to Intel. They restructured, got a big government contract. We've been criticizing them for a few weeks, but it seems like they're fighting back. Gary, thing number 3, Intel trading, INTC fights back. Thing number 3.
So, Rob, the last month or so, we've talked about Intel a lot, and it's been a little difficult, right? Because we've been very critical of the company, and with good reason. They've had reliability problems. Their foundries have fallen far behind what, Taiwan Semiconductor can do. Their ability to handle power loads, and not use too much power, which is crucial for mobile devices like laptops and cell phones. They've fallen behind Qualcomm on that. They've fallen behind Samsung on that. And so, it's a company that's had a really, really rough couple of years, and this year in particular has just been a disaster for Intel. And it's hard for me to criticize them because they're a company that I've admired. I've had Intel's i7 processors in every computer I've had for the last decade or more. It's what I have in my laptop now. They're also one of the few high-end US-based chip makers, and that's really important. Do we really want to be in a situation where, all of our computing chips are made overseas? And, if China's been very clear, they intend to invade Taiwan. Taiwan Semiconductor is the best chip maker in the world. Do we really want to depend on China for all of our chips, for anything, data related, anything AI related? The military uses a ton of chips. So it's been really hard being critical of Intel over the last couple of months. Unfortunately, they've deserved it. Well, we've had a whole bunch of events in the last week. At the end of last week, Intel's management said they were going to do something to restructure. They didn't specifically say they were going to spin off the foundry unit. That's the unit that manufactures chips versus the part where they design them. They're going to do something with that will allow it to potentially raise external capital independently, potentially to operate independently. I don't know if they're going to spin it off and have it trade as a separate company, but that wouldn't be a bad idea. Separately from that, the US government gave him a $3 billion purchase order. In fairness, I have regularly been against government involvement in the economy, but in this case, $3 billion is unfortunately not a ton of money for our government, but to keep our, key chip making capacity onshore, we might as well buy our chips from Intel rather than buying them from Taiwan. I'm not negative on Taiwan Semiconductor. Their products are amazing, but we do need to have domestic capacity. And then separately from all of that, it was announced, I think over the weekend, that Apollo is looking at making a $5 billion investment in Intel. I pretty much think the whole world, between management, the US government, and external private equity investors have all said, okay, this is a disaster, but it's salvageable. And boy, do I hope they're right. I don't own Intel stock, but I just, I want nothing but the best for that particular company.
That was going to be my question, Gary, as a follow-up. Does this make you take a second look at Intel from an investment standpoint?
I mean, I think at some point you have to. I read some really interesting analysis. I have no idea if it's true, but somebody was saying that a foundry plant, that's a fab making a plant where they make semiconductors, where they make chips. They think the value of those plants is $10 billion a piece, and there are 15 of them, meaning just the value of those assets is $150 billion. And at the time, the market cap of Intel was about $100 billion. And the conclusion was management has created negative $50 billion of value, and that's assigning no value to the brand name or the design business, which is itself very valuable. The thing about that is I have no idea what those fab plants are worth if you sell them to somebody else. I don't know, how that works if you spin it out. I also think, I want to see this company solve the reliability problems. In my opinion, it's a big deal that their 13th and 14th generation i7 and i9 processors had massive reliability problems. I think Intel management did a really poor job of addressing those. They've got customers calling them upset, and management's made the fix hard to find. They're not doing a whole lot in terms of warranty replacements. I mean, I think it's worth watching. It's a fantastic company in a lot of ways, but it's really poorly managed. And I don't know what you do with the fact that, right now, if you want 3 nanometer processing, you really have to go to Taiwan Semiconductor. And Intel has basically said, okay, we're going to skip 3 nanometer and go to 18 angstrom processing or production rather, which is 1.8 nanometers. And so, my question is, if you can't produce at 3, if you can't produce at 3 nanometers, so you're telling us you're going to do it at 1.8. I mean, this has just been a long-term problem. I hope they get it fixed, but I don't know how to figure out, from where I am, whether that's going to happen or not. My guess is the people inside the company believe it'll happen, but I don't know. And it is worth pointing out that Intel has talked about being able to produce at 3 nanometers for years and years and years, and they haven't been able to do it. And unfortunately, the power consumption and reliability problems have gotten worse. We did tell you guys, I think it was a week or two ago, that the specs on Intel's Core Ultra 2 line look amazing. Let's see. It looks like their Core Ultra 1 line didn't have those same reliability problems. So if they've got that fixed, that'll be a big deal. That would make Intel a real competitor in a lot of the mobile market that shifted over to Qualcomm and, Apple's processors, and just AMD, which is, they don't make their own AMD designs, but Taiwan Semiconductor manufactures for them. So Long way of saying, I don't know.
Good answer. That's a perfectly fine answer.
Right.
And we will keep in tune with that and adjustments, new data, new information to maybe change our opinion. Moving the opposite direction, it seems we're talking FedEx. We got Mrs. Bigley supporting the decision of the Fed to cut. Thing number 4, Gary, FedEx FDX earnings disappoints and validates the Federal Reserve.
Right. So FedEx reported disappointing earnings. The revenue of 21.6 billion was short of the 21.9 billion projected. Earnings per share were $3.60. The expectation was for 477. That's a big miss. Management talked about a mix shift. They talked about reduced demand for priority services. They revised guidance. They lowered the high end of guidance, both on the revenue side and the earnings side. None of this is good. And the problem here, the reason people in my business look at FedEx, the reason we look at shippers is because it's a pretty good view on the economy. FedEx ships for everyone. They ship for, Walmart and Amazon, and, every big company uses FedEx. And so when demand is lower, when the consumer is suffering and the economy starts to slow, that's when you start to see poor results out of shippers like FedEx. And that's why their earnings are important. That's why these misses are important. What they're telling you is that fewer people are buying things and a lower amount, fewer packages need to be shipped.
Gary, we've seen other retailers, Walmart, Target, Home Depot, adjust guidance right down just in terms of what's happening with the economy. Is FedEx earnings closely tied to those retail performers as well?
It's not a coincidence that, what was it, Rob? About a month ago, we did, I think, 2 versions of the 5 things where we were talking about all of these mega retailers, like the companies you're talking about. Again, Walmart, Target, Home Depot. These are great proxies for the consumer, for the U.S. consumer. I don't think it's at all a surprise or coincidence that right after these huge retailers announce misses, you know what? I take that back. It wasn't so much misses. They gave weaker guidance. It wasn't that they'd had a bad quarter, it's that they saw demand coming down and they gave weaker guidance. And I don't think it's a surprise that a month later, FedEx comes out with a miss themselves. These are all signs of a slowing economy. So for those of you who disagree with me, where I'm saying, hey, the Federal Reserve is cutting too soon. They're cutting too much. They shouldn't have cut right away. And when they did, they should have cut, 25 basis points instead of 50. This is what we were talking about in thing number 1 of this particular episode. If you disagree with me, this is the place to do it, right? Come back and say, okay, great. But, you're saying the economy's fine and inflation's a problem and the Fed shouldn't cut. But, you got Walmart, Target, Home Depot giving weak guidance. You got FedEx missing and lowering guidance. All of these are signs for a, weaker consumer. I fully acknowledge these are tough calls to make. And, while I believe the Federal Reserve made the wrong call on this one, it's not that anybody's crazy here. There are lots of smart people who look at the data and can come to different conclusions. And that's all that's happened here. But, for the people who disagree with me, this would support your point of view on it. And, this would be the weak point of my argument that the Fed cut too soon. Like I said, these are complicated issues, and you have, lots of smart people looking at lots of valuable data, coming to different conclusions. And that's all right. That's a normal thing in the market. We disagree all the time. And, one thing to remind people of is every single time you buy a stock, there is somebody who disagrees with you selling it to you. Every time you sell a stock, you're like, hey, I made money in this, I'm going to sell it. There's somebody on the other side of that trade buying it who disagrees with you. And so, one of the really interesting things about doing what we do for a living is you just get really comfortable with the fact that there are lots of really good, smart people who disagree with you every single day. Every time I'm buying, someone's selling. Every time I sell, someone's buying. So, it's all right. We live in this world where disagreement is normal. And, the most valuable thing that I have in my life and in my business are some really smart people who are, great investors and other hedge fund managers who disagree with me on a regular basis. Nobody gets upset. We call each other, we discuss, we debate, we share information. We will give each other, hey, I just got off this call. This is what I found out. I just modeled this out. This is what I've discovered. And you always want to talk to the people who disagree with you, and we're happy to do it. So it's kind of a quirky part of the world where we're just very comfortable and happy to talk to the people who disagree with us. And that's where we are on this point.
One of the things that stood out to me, Gary, when we first met was you told me, how would you feel, Rob, if I was the other one on the other side of your trade, right? So we talk about maybe inexperienced investors, right? Or not professional investors, right? And I said, well, that probably would not make me feel pretty good, Gary, if you were the one disagreeing with the amount of time that Deep Knowledge spends researching these positions and making these calls. But I think that's where the true value lies as well. For subscribers is, Gary and your team, the amount of time you're spending on these positions, researching them, understanding the macro environment and its implication to a lot of these positions that Deep Knowledge is taking up as a recommendation for our subscribers.
Thanks, Rob. I appreciate it. Um, the, you know, I appreciate that. The other thing that we do, though, that I think has huge value is when I hear that there's, somebody else who I respect or who's smart, who's done a lot of work on something, and they disagree with me, my first reaction isn't to get upset, it's to call them and say, hey, I see that you're long this, I'm short it, or you're short this, I'm long it. I'd love to talk to you. And you'd be amazed. They don't get angry, they don't get upset. They're like, yeah, let's talk about it. And it's in trying to understand the other side and figuring out, are you missing anything, or is someone else missing something? Where's the error in this? It's being willing to confront the other side of any discussion, any argument that I think takes the people who are really good at this business to another level.
Gary, with that, thing number 5, as we mentioned, we are working more investor education type topics, or if novice investors out there, the question is, if someone tells you there's gold underground, how do you know there's gold? And thing number 5, we're talking about gold/investment research. Gary, I think goes a little bit without saying, but let's further dive into why it's so critical to do your own research, to validate an opinion, or to even know what you should be looking for.
Yeah, so this one and this image comes from my friend Raji Kabaz at Learn Wall Street. Raji and I ran Silver Arrow together for 8 years. He's one of my best friends, one of the best portfolio managers, one of the best investors I've ever known. And one of the things that Raji would always do when we were working on something is say, we talk about something that people would accept as a fact. And he's like, but how do we know? And it was a great question, right? People tell you things and you think it's a fact, but is it? And so we got a couple of examples for you. And this should illustrate to you, whether you're a novice investor or a professional investor, the importance of doing your own work and being open to, potentially that you're wrong about something. So if we go back to the 1990s, there was a Canadian company, it was a mining company called Bre-X Minerals. And they claimed they had found this enormous gold find in the middle of the jungle in Indonesia, right? I mean, and it made sense, right? Like nobody had seen it before. And the stock rose from 20 cents to $280, right? I mean, this is, people think, oh my God, I wish I'd owned NVIDIA or Apple Computer for the last decade or so. This was unbelievable, 20 cents to $280 on the basis of this gigantic find. And so, skipping ahead, it turns out there was no gold. I mean, none at all. So the question is how? How did that happen? Well, it turned out that the core samples were salted. I'm going to explain that. So when you try to figure out how much gold you have underground, and not just gold, any mineral, you dig a core sample, right? I mean, you can't just excavate the whole world, right? You can't just pick up the whole world, sort it, and say, where's the gold? So what they do is they dig a deep core sample, and this circular drill basically brings up it brings up what's underground for however deep you drill. And then they take a look and they say, okay, you know, they drill however many samples and they say how much of the stuff that we're looking for is in the sample. And, you know, if you have a certain amount of gold in that core sample, then you realize, okay, great, we have gold underground. We have a great find. We're going to get rich, right? It's sort of like the gold version of the Beverly Hillbillies. Well, it turns out what happened was the samples, the core samples were salted. So somebody took external gold and literally sprinkled it on the sample to make it seem like there was plenty of gold underground. Well, the whole thing was a lie. There was no gold. The gold had come from someplace else. The samples had been adulterated or, you know, made impure. And not kidding, somebody who was um, the chief geologist of the company, or somebody who looked like him, exited a helicopter in flight. And there are a ton of stories about it. You know, one of the stories was it was just an accident and he fell out. Another story was, you know, he was thrown out. Another story is he was killed on the ground and then thrown out of the helicopter. Another story was they just found somebody who looked like him and that person was sent out of a helicopter. The point of all this is it turned into a gigantic mess for everybody, both on a financial and a personal level. You know, when somebody tells you there's gold underground, now, you know, what do you do with that? You obviously, you know, you can't get on a plane and start drilling core samples in the middle of the jungle in Indonesia. That's not realistic. But, you know, you sort of have to figure out, does this make sense? What do I know? What do I not know? And realize that the risk of a property that hasn't started producing is very different from one where they are producing gold or copper or uranium or, you know, whatever it is you're digging for underground. And, you know, it's all right to take those high risk flyers, but the way you control that is with position size. You don't believe people when they tell you something like that, you know, you can't confirm. And if you feel like, you know, you want to take a position, you take a 0.5% position, a 1% position in something like that. The problem with Bre-X was people ended up with huge positions and it created a gigantic problem for people. Now, you know, that's one of those complicated things where it's really easy for somebody to say, hey, okay, but how could we know? And that's a fair point, right? None of us were getting, I mean, I knew about this. I wasn't invested in it, but none of us were getting on planes, you know, dropping out of helicopters with parachutes, you know, into the Indonesian jungle to drill our own core samples. But there are examples like this in the hedge fund business. And, you know, back in 2012, I went to an investment conference and, you know, there's a hedge fund manager there who gave a great presentation on Viacom. And at the time, every large hedge fund had massive positions in Viacom, CBS, and Disney. But the reason they owned Disney, it wasn't because of the theme parks. They owned Disney because Disney owned ABC and ESPN. So everybody had these huge bets on linear TV, which linear TV is just, you know, TV 15 years ago, right? That's all it was. And I did some work on this and realized, wait a minute, this doesn't look right. And I called a friend of mine who was a partner at a multi-billion-dollar fund that I knew owned Viacom and CBS. And I said to him, how did you get comfortable with the risk of streaming television, YouTube, Hulu, Netflix, piracy, DVR powered commercial avoidance? Like, how did you get comfortable with those risks? And his answer was, I haven't thought about it. And so, Rob, what was happening was every single hedge fund that owned these things, they were all talking to each other and they were all believing each other. But, you know, everybody listening to this right now, they're all like, well, yeah, of course, streaming television has changed everything. Of course, you know, nobody's watching regular TV and watching commercials. We're all watching YouTube or Netflix and, you know, or people are illegally downloading or, you know, people are using streaming television as a way of avoiding having to watch TV with commercials by appointment. But the thing about all this is you could have known all this in 2012. People knew what Netflix was and Hulu and YouTube. We knew what these things were in 2012. You just had a bunch of people talking to each other, believing each other who weren't looking anyplace else. And that's the whole point, right? If somebody smart tells you something, they may be smart, but they may not, they may be talking to each other instead of doing the real work. And so, is it hard to figure out how much gold is in the Indonesian jungle? Yeah, that's really hard. And if you're going to do that, keep it small. But it's really easy to look at things like TV and say, wait a minute, is this business the way it's been for the last 50, 75 years? Or is it changing? And this was a situation where you could see the changes coming from years ago. You could see it coming, years at a time. And, with what Raji and I did was we produced a 50-page white paper called TV is Next, explaining how linear TV was going to fall apart. And within 2 to 3 years, Viacom, CBS, Disney, they all got hammered horribly because the old linear TV, nobody wants to watch television via appointment. You want to watch the show you want to watch when you want to watch it. You don't want to have to be in front of the TV at 8:30 and deal with 18 minutes of commercials an hour. No one wants to do that anymore. And so sometimes these things are easy to see. You just have to be willing to take a fresh look at it with your own fresh eyes and be skeptical of things and be willing to do your own work and dig into these things. And so, it's a really long way of saying, if you're going to commit capital on something, spend some time researching it. And, I know it seems hard, but if you understand how you like to watch TV, you could have figured out Viacom was a sell in 2012.
There are signs everywhere. That concludes this week's version of the 5 things, the We Pivoted Bigly issue. Thanks again, everyone, for tuning in, whether on YouTube, wherever else we might have it. Actually, YouTube's the main one, right? YouTube Shorts will have these clipped up all over. We ask that you please visit our website, deepknowledgeinvesting.com. Sign up for a free subscription where you'll be notified of all new content material that's out there. And thank you to our premium subscribers, as always, for allowing us to put time back into the business and get you more data, more insights, and more research on those positions that DK has identified as high alpha positions in your portfolio. Gary, any closing thoughts from you?
Yeah, first of all, I always like to thank the people who've taken the time to watch this. We really appreciate you. Thanks for spending your time with us. And typically in this spot, I always make a point of acknowledging the incredible work our interns, Andrew Brown and Alex Petro, do on the 5 things. Their work here is incredible. This week, I think they did about 90% of the work on this. Great job, guys. But I had a really terrific experience over the weekend, Rob. We had an event here in Connecticut, and 3 of my former interns made the trip to come spend the afternoon with me and a member of the DKI board of advisors. And, we just had a great day together. And, we talk a lot about Andrew and Alex and the great work they do, but there were, 7, 8 of these guys who came before Andrew and Alex, and they all contributed their time and their effort and their work and their intellect. There is now a multi-year long line of DKI interns who have not only graduated from college, but gone on to get great jobs in finance. They stay in touch with me. I talk to them. One of them just got a new job and we had a chance to catch up in person, and he's going to be starting in 2 weeks. We've had some terrific people, some terrific young people contribute to the work that we do here. I'm grateful to all of them, and I'm proud of every single one of them. And guys, it was great seeing you over the weekend. Andrew, Alex, great work this week. And we'll see all of you guys next week. Thanks so much.
Thanks, everyone.